Hey, welcome to our Market of the Moment update, week of July 25th, 2022. Chris Madrid, what's up?
What is up?
What is up? Temperature's up. So let's take a look at this week's numbers. A lot of things stayed pretty much close to the same. Collin County, we did drop another 1/10 of a point on our sales price to list price, but we're still nearly 5% over market value. As I'm looking at comps and going through the MLS, this is definitely a price point number here. The homes and anything in the 3s and 4s still going quickly and going for over ask, where you get into the 6, 7, 8s, and we're starting to see those 20, 30 days on market, price reductions, things of that nature. Days on market remain the same in all 4 counties here in the DFW market, 7 days here in Collin County, which it's been there for a couple months, I believe. We did drop our monthly supply down by 0.4 of a month, which we had been seeing inventory grow in Collin County. New listings, we had 511 versus 2 weeks ago, we had 492 hit the market. 2 weeks ago, we had 253 sell in Collin County over the course of a week. Last week, there was 350 sold. Denton County, everything remained the same, about 4.5% over list, 7 days on market. They kept their 1.9 months supply, which is very close to Collins. 537 new listings in Denton County this and last week versus 455 2 weeks ago. Sold remained pretty close to the same, 334 this week versus 303 2 weeks ago. Dallas County, most of this remained the same, 7 days on market, 3% over list. Supply did tick up in Dallas County by 1/10 of a month, 1.6 month supply, and new listings 608 this week versus 656 the week before. 506 sold versus 417, so nothing stark standing out there. And then up in our rural county, Grayson, let's see, prices went up actually a little bit. We were just at 100.1% 2 weeks ago. It's up to 100.3%. Most likely people getting driven out of this DFW market, moving a little farther out to find affordable housing. So price ticked up a tad. Days on market remain the same at 11. Month supply ticked up 1/10 of a month to 2.7. And you had 79 new listings last week versus 64 the week before, and 63 sold versus 59. Let's look over to the west in Tarrant County. Sales price, list price remain the same, just around 3% over ask. Days on market went down one day. They were at 7 down to 6, probably meaning competition maybe a little picked up a little bit. 1.6 months supply, which is a plus 1/10 of a month. New listings 771, 566 solds. Both are up from the previous 2 weeks. Parker County, list price to sales price dropped just a tad, negative 0.1%, paying just over list price in Parker County. Days on market remain the same at 11. 2.6 months supply remain the same. 113 new listings, which is right on, pretty close to 2 weeks ago, and 78 solds. And then we jump over to eastern Dallas and the Rockwall County. Sales price is 2% over list, which remain the same. Days on market remain the same at 9, and 2.3 months supply remain the same. Had 83 new listings in Rockwall County and 46 solds. So when you look at some of these, you can tell how the market is shifting a little bit, because we're we're seeing a lot more new listings versus what is selling. So, for instance, in Collin County, you have twice as many homes got listed. Excuse me, not quite twice as many, but more large number got listed than sold.
Yeah,
so
sure.
it's not a balanced market as you look at all of these, not balanced, but it looks a little more balanced than it did 2 weeks ago. So last thing I wanted to follow up with was, we were looking at this earlier. This, all of these is advice from Diana Olick, which is a CNBC journalist, speaking on the housing market. So if you go back 7 years to October 2015, she is basically telling you to rent. This is maybe not her headline, but the message here is to rent, not to buy, because the market is crashing, is what all these headlines are leading to. So Chris and I just wanted to give you a rundown.
Oh, man, this fires me up for sure.
Yeah, just give you a rundown. If you had been listening to Ms. Olick's advice over the last 7 years, how much money you have lost, and most likely how much money she's made owning rental properties, most likely. But back in October, had you bought a house prior to October 2015, let's say if you bought a house in 2014, October for 300,000, that home after 1 year would have been valued at 315 with that year's 5.1% home appreciation. She is saying a bubble larger than 2006 was happening. So with that headline, she's encouraging you not to buy because the market's crashing and you're going to lose your money. But if you listen to her, you lost $15,000 and your landlord paid $15,000 more, or paid off probably that much toward their mortgage.
Yep.
August 2016, she's saying we are in a new housing bubble. And that same home you had bought in 2014 is now worth, what is that, Chris?
332. Yeah,
332 with the 5.4% appreciation. She continues in November. Home ownership doesn't build wealth, study finds.
Yeah.
All while this home you bought in 2014 for $300,000 is now over 350.
Mm-hmm.
And then in December of 2019, just
18.
prior to,
oh yeah, you skipped it.
I'm jumping down because it's just the same.
But it's just, man, it's so crazy.
The housing market is about to shift in a bad way for buyers. December 2019, a few months before COVID, she is saying next year will be hard on the housing market, especially in these big cities. And we all know what has happened since December of 2019 or 2020. Yep. The housing market's gone crazy. She's still telling you to rent. That home you paid $300,000 for is now worth $424,000. And I'm sorry, but $124,000 of that is wealth. Where yep. She is saying there's a study finds in 2017 that it doesn't build wealth. And then finally, July 2021, housing boom is over as new home sales fall to pandemic low. And that home you bought 7 years ago is now worth over $500,000. That is assets and wealth for your family, not for a landlord's family. So if you add all of this up over the course of 7 years, you would have had 55.7% appreciation on your $300,000 home, equaling a $209,000 appreciation in that asset, which allows you the ability to do lots of other things. You are building wealth. It's generational this way. Yeah. So, and really the point here, I believe, is Chris and I want you, we come every week with the facts, with the data. There's a ton of news out there. If you're listening to the wrong news, it can be very costly for you and your family. In this instance, we just showed you, it could have cost you $209,000 over the last 7 years. What would you like to add to that, Chris?
No, I mean, that's just, I like to think about the just again, from a financial perspective, right? That ultimately you're building equity, right? Is what's going on in those scenarios. So if you had, let's say that you have, you're paying on high interest credit cards, car loan, whatever it is, that's preventing you from being able to tap into the equity, right? Or not having a home, not having purchased a home, you have nothing to tap into, right? So if you would have owned that home, credit cards got out of control due to COVID, or there's, man, I talk to customers all the time. The ones that own homes were able to take equity out of the home, pay off high interest debt, and ultimately free up cash flow. Now, if you don't own a home and you don't have an asset like that you can borrow against, you don't have that option, right? So you're ultimately going to be paying high interest over a course of however many years to try and get out from under those the high interest credit cards or whatever it is. And we've helped several families over the last couple of years, especially with equity building as rapidly as it did, to be able to pull out some of that equity, pay off your high interest debt, and now they're in a much better financial position, right? And ultimately, if you don't have an asset like that, then unfortunately that's not an option. So
get started today. We're going to cover our normal topics: rates, trends. We're going to talk a little bit today about how inflation drives mortgage rates to start off, and then when will this inflation peak, and are we already in a recession? Some things we're going to talk about today. So Chris, take it away.
Oh man, yeah, coming to you from Guaranteed Rate, we are the home purchase experts. And obviously, ultimately us doing these videos, work with somebody that is digging into this, knows when the best times to lock in your interest rates are, and capitalize on inventory and obviously the decrease in home prices. So man, great start to this week. We did have a Fed meeting this week, which we knew the Fed was going to increase federal funds, right? The federal funds rate by 0.75%. So I was getting calls, Monday, Tuesday, Wednesday. Hey, I heard rates are going up, 0.75%. Am I locked in? All that good stuff. And thankfully we did have several buyers already, locked in. But it was also a really good time to be able to kind of calm some of those fears, where a federal funds rate increase doesn't mean that mortgage rates are going up by the same amount. So the federal funds rate, again, right, for those maybe that haven't caught one of the videos, is essentially the rate, short-term rate, that banks lend to each other overnight, right? So that's what the federal funds rate is. The federal funds rate is also tied to prime, or the prime rate, and that's normally what credit cards are based off of, your auto loans, some student loans, just some of the shorter term type loans that are out there. That's where they'll get that rate, or the margin comes from, is from the prime rate. So yeah, one of the things that obviously we want to talk about here, this is inflation drives mortgage rates, and it's something that we've been talking about for the last several months, as we've seen inflation climb, here in 2022, well, ultimately 2021, and now, it's reached what we think is its peak in 2022. Mortgage rates have gone right along with it, right? And we can chart this back all the way to the 80s. So there's three things that we're looking at here in this chart, right? The CPI, which is a consumer price index, and that's a measure of inflation. We're looking at the 30-year fixed rate mortgages, and then the darker blue there is the recession indicators that have happened. So again, we can go back to the 80s and see, hey, inflation went up, mortgage rates went up, and then coming out of and ultimately as inflation went up, right, we started to see these recession key points over, the 80s, the 90s, early 2000s, the Great Recession of 2008, right, which everybody remembers and everybody talks about. And then again, we had a small one there in 2020, obviously, due to COVID. But the width of it, right? If we're looking at the width, that's essentially how long the recession lasted, right? So of course, in 2008, 2009, early 2010, that lasted a lot longer than majority of these over the last 40, 50 years. But as we can again clearly see here, once you start to see inflation taper off, well, then mortgage rates come down along with it, right? So I'm hearing a lot right now, hey, do a 3-1 buy down or a 5-year buy down. And ultimately, if we knew interest rates were going to stay in the 5, 6, maybe even go up to the 7% levels for the next 5 or 10 years, that may be something to take advantage of. But ultimately, as we start to see inflation come down, we feel that mortgage rates are going to come down along with it, right? So this could be the next 8 months, could be the next 10 months, but ultimately we feel like mortgage rates are going to come down. So before dumping a bunch of money into buy downs, into discount points, again, have a conversation with somebody that kind of knows this data, and again, ultimately we can back into the numbers, right? We can do some pluses and minuses to see if it's going to be beneficial, right? If whether or not it's beneficial to pay points or do a buy down to lower the interest rate for a shorter period of time.
Yeah.
Right now, so if we're talking about current interest rates, we are in the 5.1 to about 5.3 range in a 30-year fixed, which is great. And that a lot of that is we started to see more, the mortgage-backed securities market just really rally on the Fed meeting from this week, and we finally broke 100. So if we're looking at that, the candlestick farthest to the right, that is the July 25th, right? We're seeing that where mortgage-backed securities was pushing on that low on the moving average there, but is now broken above 100, which is awesome. I mean, that's if we can get past that 10, like that 102 ceiling, right? So we're, as of right now, so this is live, we're at 101.39. So the 101.655 was earlier this morning, so it's come down a little bit, but we're still up 36 basis points right now at 101.39. So if we keep moving up to that 102 number, we've got, there's a lot of upside there to get into 103, and then ultimately that's where we're going to start to see mortgage rates really come back down a little bit once we get above that trend.
Cool.
So yeah, these are, again, we're going back, we can see what mortgage-backed securities have done since May, and the highest level was right below 102 back in May, right? So as we start to push above those averages, right? 25-day moving average, 50-day moving average, 100-day moving average. That's when we really start to see mortgage rates come down. So clearly, though, where rates are today are lower than we've been, in at least the last month for sure. So maybe a good time to lock in if you're looking to buy.
All right. You mentioned in there a little bit about there is some talk that inflation has peaked or is getting to its peaking point. The last chart maybe showed a little bit of signs of that as well. So when are you predicting, based off this chart, when will inflation peak? This is also talking about some upcoming Fed meetings.
Yeah. So the tough part is a lot of this information. So this was put together in July, right? So the June numbers came out in July, right? So ultimately we won't know until probably the middle of August whether inflation has peaked in the month of July. But then again, I would say if it hasn't already peaked in July, then it will be peaking probably here in the next couple of months, especially after the most recent federal funds increase. And ultimately, what the Fed is doing is they're trying to combat inflation by increasing the federal funds rate. They're trying to slow down the economy. And again, that's a tactic that they've used for the, since we talked about it before, I think since the 60s, right?
I think our next slide kind of demonstrates that as well. So
yeah. So that's right, exactly right. So Fed hikes lead to recessions, and it's the only tool that they know how to use to essentially combat inflation. So we've seen that, since the 50s and 60s, they've increased the federal funds, throw the economy. That it's so funny. We talk about these, boom bust cycles in the economy, and this is why, right? Because you have Fed chairs that just don't get it. And it's a repetition every single time inflation starts to get out of control. They're like, hey, let's increase federal funds. That's the only thing we know how to do. And again, it ends up stalling the economy, throws us into a recession. And then it's like, man, it's cyclical. It happens over and over again. But again, I mean, that's ultimately what that's where we're at. So yes, hopefully we are on the back end of inflation, and it has peaked, and it's coming down. We did get this morning, we did get some indicator of GDP that GDP for the second quarter is going to be below zero, right? So negative territory, which would mean first quarter and second quarter GDP is in the negative, which that's a telltale sign of a recession, right? If you have two back-to-back quarters of negative GDP, which is the gross domestic product, right? That you're in a recession or will be headed into a recession. So
it's the definition of it. So I guess it would be safe to say